Bond prices touched a 14-month high yesterday, while yield of the 10-year dipped to 8.18 for the first time since September 2013 on the back of falling crude and commodity prices globally. Today, yields have inched up just a bit as an RBI executive director warned that inflation still remains sticky. However, bond dealers remain bullish, hoping for a rate cut sooner or later. The rupee also has weakened just a bit on the back of increased demand for dollars from importers. What are the key triggers for the money market from here on? We've got Latha joining us. Also joining us on the show, JAYESH MEHTA of Bank of America and JAMAL MECKLAI of MECKLAI Financial Services. Latha, let me toss it over to you to take this away.
Well, is this a question or is this an invitation for asking questions? Well, personally, I would think that a lot will depend upon what the inflation number will be tomorrow. The CPI number comes out at 5:30. The expectation is that it should be 5.7. That's the CNBC T18 poll. Other polls will be 5.8, 5.6. But if it comes seminally below, which it has done in the past 2 months, September, our poll was over 7%, 7.2 actually. The number came in at 6.46. For the month of August as well, the poll was closer to 8 and it came in at 7.28. So for 2 months in a row, inflation numbers collected or given by the CSO is so drastically, a good 70 basis points, 80 basis points lower than street expectations.
So if it should come in much lower, the pressure on rate cuts?
The expectation of rate cuts will continue. Pressure is another matter altogether. Depends on the person who takes the pressure, and I think this guy is not taking. But that's the point at which we can invite our guests to speak. Jayesh MEHTA is with us, as is Jamal MECKLAI. Good afternoon, both of you. Jayesh, what's your take? Do you think the market is moving on only on rate cut expectations, and if that expectation doesn't materialize on December 2nd, yields will spike back?
I think market is, I would say, very few people, percentage of the market is really expecting a rate cut in December. I think what the rally is happening is about thematically looking at next 1 year, right? And in that perspective, people are looking at in 1 year's time, if the growth story in India continues and the inflation target of 6% is quite achievable. So we are then looking at 10 years to come down to 7-quarter levels or so. And in that situation, people are not really bothered whether it's December, February or April, whenever the rate cut happens. But definitely, like earlier when people used to start thinking about in August was no rate cut in whole of 2015. Now it's like, I would say 20% probability for December, 50% probability for February, and maybe another 20% probability for April. So that is the kind of thing we would look at it, and that's what people are building up on expectations. So if there is no rate cut, but even if he talks a little bit dovish, market's going to be continuing the momentum. If not, maybe the momentum would be broken up. Maybe the yields might go up by another 10 basis points or so. Of course, in between, technically 818, 817, can it go to 825, 827? Yes, it can go to 825, 827. But thematically, we are looking at 7-quarter in a year, and that's what the street is pricing at.
Okay, the other big story that's playing out is what's going on with the dollar. So we'll bring Jamal in on this. Jamal, loved your column in the Financial Express today. I was curious to know what you make of, what the consequences of this continuing incredible strength in the dollar that we're seeing. Not surprising, given what the various expectations of Fed positions are likely to be over the course of next calendar year. But what do you make of the dollar's strength?
Well, I'm an old guy, so I remember things. And I remember, back before 2000, the dollar just kept going up and up and up and up. I mean, it was insane. Nobody could understand it. Then we realized that actually the euro was just being born, the yen was dead in the water, and gold was at $300. There was no place to put your money. And I just got a vibe that, we might be going into another cycle like that. See, Europe is, it's in pretty bad shape right now, and nobody really knows which way to turn. So, if you're putting money in, I wouldn't put it into euros, right? Japan very clearly is looking to, come out of these years of deflation. They're working on it, but clearly that speaks a weaker yen. Gold, well, it's over 1100, which is a lot in my view. So we could be getting into another cycle where the dollar just rises and rises and rises. I wrote in my column. I mean, last time it went up to 120 on the DXY. It came back down to 72. Today it's back at, it's gone as high as 87, which is the highest level in a long, long time. But, I mean, at some level you say you ain't seen nothing yet. If it's come from 120 to 72, what is 87, right? Now, of course, it's not going to happen tomorrow. It's not going to happen overnight. But I really get a sense that we might be in a completely new phase. One more very interesting thing I saw just recently is the U.S. trade deficit, something that in the old days, the only thing you heard about was the U.S. trade deficit. After a long time, we're hearing that word again. So we might be getting into a cycle where, I mean, the U.S. is the only economy that's growing, so they're going to be big imports. Exports are going to be down. So maybe we might get into that same thing where the dollar keeps getting stronger and the U.S. trade deficit keeps widening till one day it gets too much and goes the other way. So it's an interesting scenario. I mean, I don't know what's going to happen, but I think it's worth, thinking about and perhaps worrying about.
So the euro has gone from 1.4 levels to roughly 1.24 levels. The yen is down to 115. What do you make, Jamal, of where the rupee could be headed?
Well, this is the big trick, right? Because since we really do appear to have a government that is moving and shaking in the right direction, obviously India is a pretty good, I mean, to me, India is number 2 after the US right now. So there is money coming in. RBI is trying to suck it up. And I think it's going to be very difficult. In fact, coming to the earlier discussion on interest rates, my personal belief is I don't think Rajan will or should cut. But if he does, I would say he should do something dramatic, because part of what he also needs to do is he needs to get people out of the mindset that the rupee can only strengthen, right? So he's caught between a rock and a hard place. I mean, he should keep holding rates high. Incidentally, Jayesh, hi there. I mean, 7.25, 7.25 seems very aggressive to me. Because while I think interest rates will come down, but I think this is India. And growth is really, I think growth is, we ain't seen nothing yet. I think we're going to see 7% in next year. So I think inflation is going to remain a problem. I don't see interest rates coming down that far, which again will keep propping up the rupee, which could be a problem for exports. So it's all sort of feeds one into the other. I mean, that's why we're in this business.
All right. Fair enough. Jayesh, before I get your response to what Jamal has said, I'm going to throw this to Latha as well. I think this conundrum, if I may call it that, between, fighting inflation with high rates and yet what that means for the rupee. What's your sense of how RBI is reading that?
It's a traditional dilemma.
Yeah,
or a
I'm not saying it's new in that sense.
He said that. I don't think at the moment that is a serious problem for Rajan. For Rajan, the appreciating currency is for a whole host of other reasons. India is the only place where growth is believed to have bottomed out.
Sure.
So even if China's absolute 7.3 is greater than India's 5.7, the delta is lower. So, people will rather go to a place which is going from 5 to 5.5 rather than from something which is at 7.3 to 7.2. Yeah. So India is just the place where growth is expected to be, and the macros are all playing out very well. So the money is coming in for Rajan. I can agree with Jamal MECKLAI 200% that he has a problem with an appreciating currency, and he did not mince words.
And also the expectations of appreciating currency.
And if you analyze the Q1 numbers, Q2 numbers are still coming in. Clearly, the big growth came from exports. Even today, look at yesterday's Bharat Forge numbers. Yeah. The export is the big force, and Rajan knows that more than anyone else. He will not want to scotch that, and he will not want to get into that 2013 syndrome of an overvalued currency, or even the 2012 syndrome. So he will have a problem over there. But I think the yield issue he will have to deal with as basically inflation and inflation expectations. Exactly what Mohanty said today, Deepak Mohanty, and that is why the yields have inched higher. If an inflation expectation is still a problem, the Indian public is adaptive in terms of its inflation expectations and not rational. So the feeling will always be, oh my God, we would still have double-digit inflation. It's only slowly will come down when you see a sustained period of lower tomato prices and lower onion prices. It takes its time. So I don't think the RBI will hurry with its rate cut at all. I find 7 quarter also very, very aggressive. Jayesh's number.
Okay, let's get Jayesh to defend that.
Yeah.
Jayesh, you want to defend 7 quarter and also give us an insight on how foreign investors are looking at both of these parameters as they continue to pump in money in India's debt markets as well as in equity markets.
Okay, I'll just add one question to what Menaka has asked you, Jayesh. Are you saying yields go to 7 quarter, but RBI need not necessarily go to 7 quarter? Yields will just be ahead of the curve.
Yeah, it will be, and we actually expect that in 2015, if the growth story which spells out, right? So I would put a 10% negative caveat to the whole story of 7 quarter and rupee being stable range 60, 62, maybe slightly appreciating bias, maybe technically can go to 62, reach 62, but nothing really serious as last time. If the equity investors really get disappointed by the budget and the growth story does not really spells out. But I think the way the government is moving about and the way the government is going about, we are into the phase, and if we see some large project getting delivered into production by the budget, and if the budget comes out what it looks like, the government working very hard on it, and if the growth story pans out, there is, I would say, we just started the equity inflows. It's just the beginning of the equity inflows. So 90% probability I would put it to that, and that's where, if you really look at the growth in the country is there, the money will pour in, right? That's what we saw in 2005 to 2007. If there was a growth, US yields were at 5 quarter, India yields at a 7 quarter or 7%, yet money was pouring in and currency was remaining quite stable, or to an extent like there was a huge appreciating bias on currency. So it's ultimately all about the growth delivery. Right now there is growth expectation. If the growth delivery does not really spell out, even the fraction of it needs to get spelled out by budget. If it comes into production, that's great. If it does not, then there is a fatigue. There is a 10% chance there is a fatigue. Equity investors would actually move out of the fatigue into the expectation, and that could kill the story. But if that remains well, and I would like to believe that that will happen, if there is growth, the money will pour in. If money will pour in, and government's doing their best on, and we have every conditions right now. Of course, oil, even if it goes by another $5 higher, does it really matter from an inflation perspective? Not really. So we are looking at, yes, 6% achievable. I think inflation expectation is something which we really need to figure it out, that where that inflation expectation survey is being. There was a recent article that where the survey is actually coming from. So that's a little bit different situation. But I would say market will run ahead of the rate cuts. And if you look at the OIS market, it's like 5-year OIS today trading at 740. Of course, that one can say it may be a little bit stretched, but that's what the market expectation is. So 1 year playtime, it definitely at this juncture looks like 7 quarter.
We'll get back to our discussion on what's going on in the credit markets, in the money markets. Jamal, what is your threat perception of, or how all of this will play out from here onwards? A variety of different ways to look at it. How foreign investors, both in the debt and equity markets in India, will be looking at both currencies and yields. How Indian corporates are, looking at both of these because we've been raising quite a bit of money offshore over the last few months. So, what do you make of the various challenges that you see play out over the next 6 to 8 months?
Well, I think I was talking to a very large real estate fund, and they were saying that, the global pension funds are now beginning to not simply look at India, they're spending money, doing due diligence. So I think you're going to see sort of direct investment coming in. The other hand, I was talking to a very large hedge fund, and they, of course, just looking at inflation, think the rupee needs to keep depreciating 5-6% a year. I mean, they seem to be a little removed from the market because with all the flows coming in, it's going to be very difficult, in my view, for the rupee to depreciate. However, touching on the dollar strength overseas point I mentioned, and the fact that global growth, with the exception of the US, is still, flat on its back, really, in many senses. That's what I feel is going to be the real problem, is that how it's, and we've had this problem before, right? You're happy to have the inflows, but how do you manage the pressure, the appreciating pressure on the currency?
Does it make it easier this time,
really
Jamal, that the dollar is so strong?
No, it makes it more difficult, no? Because if the dollar is strong, all other currencies are weak, which means the countries you're competing against, or if you're selling to Europe, unless your currency weakens also, the imports are more costly over there. So when the dollar is strong, everything else goes down. If you don't go down, you sort of stand out and it becomes more difficult to do business, right? And this is particularly true when the global economy is not doing well. So, you know, to my mind, really, I think this is a signal, I've mentioned this before, for RBI to actually, I'm talking now on FX, they need to really deepen the market. You know, $20 billion, $30 billion shouldn't create drama. Okay? So what's happened is that the Indian economy has moved on at a particular pace. The markets have not kept pace. The liquidity in the markets have not kept pace. And I think this is really, so this is really how things evolve. You know, we go through these processes from time to time. I think we're at a point now where we need some more deregulation.
All right, gentlemen, we're going to leave it there. We appreciate both of you joining us. Jayesh, Jamal, thank you very much for joining us. Latha, thank you very much for joining us. That's a quick view and set of insights into what's going on in both the yield markets as well as the currency markets at this point in time.